Joanne can call.
She's on.
It's on.
Okay. Mr. Chairman, I'd like to call the Finance and Personnel Committee to order. We have a presentation this evening of the 2016 Town Audit by Independent Auditor Marr and Dussel. And with us tonight, we have Tim Morgus, Vice President, and Dustin Starr, Audit Manager. This state-required audit was reviewed previously. So gentlemen, I'm going to turn it over to you and let you take over from there.
Okay. We have a stack of documents we distributed. It contains 3 different reports for this evening. The top one, entitled Communication to Those Charged with Governance, is the required communication under generally accepted auditing standards. We'll go over that briefly. Then we have the middle package is the financial statements. We'll go over that. And then the final document is related to suggestions that we had during our audit and some things we wanted you to keep in mind. We did issue a DCD report as well. The Department of Community and Economic Development requires that you issue a DCD report. So that was done earlier in the spring, and it is really a summary of the financial information we'll go over. It does not include footnotes. It's in a prescribed form by the DCD. So to start off with the communication to those charged with governance, we were engaged by the town to perform an audit in accordance with generally accepted auditing standards in our engagement letter dated January 13, 2015. And that simply was to provide financial statement audit and DCD as well on a regulatory basis of accounting. Significant accounting policies we'll go through in footnote number 1 of your audit report. There were no significant changes to your audit policies. We'll go through those as we get to that report. Accounting estimates, all financial statements have estimates. As we know, estimates and actuals sometimes differ. We like to point out significant estimates that you have in your financial statements that we feel are sensitive. We don't feel any of your estimates are sensitive, however. Generally, they're all pretty straightforward. Disclosures, the financial statement, staff disclosures, footnote disclosures. There aren't any footnote disclosures, so they're sensitive as well. So there are none that we issue separately in this letter. Difficulties encountered in performing the audit. We did not encounter any difficulties in performing the audit. When Dustin said that my job here was to go over the highlight of the audit, I thought he meant for me to bring highlighters, so I brought highlighters for everyone. I didn't know I'd have to talk. But,
get a highlighter out of it.
The corrected and uncorrected misstatements or audit adjustments. Typically when we do an audit, we sometimes have audit adjustments. That is where we come across a matter that is not, that needs corrected, and we propose an adjustment to management. Management considers the adjustment. If they agree with it, then they'll post the adjustment. So we encountered no instances where an audit adjustment was necessary to make your financial statements in accordance with GAAP, generally accepted principles. So that's a good thing. That one thing that means to me is that you can rely on your financial statements as being accurate. Now, when I say your financial statements, I'm referring to the financial statements from your accounting software, your general ledger financial statements. So, no disagreements with management about financial accounting reporting or an auditing matter. Management gave to us a representation, which is a letter that simply says they agreed with the financial statements, and they told us everything to the best of their knowledge and belief. Management consultation with other independent accountants. We did not note any consultations with other independent accountants on an accounting matter. Issues discussed prior to our retention. We had no issues that we discussed with management before we agreed to do the audit. In other words, we made no side deals to conclude on a certain way before we agreed to do the audit. Other matters, you're required under GAAP to have required supplementary information, RSI. So we'll go over the RSI when we go to your financial statements. That's something that's in addition to what other financial statements might have. So it's just a couple of paragraphs talking about that. So that concludes the communication of those charged with governance. The financial statements, the next package that you have before you, the thick package. Our intention is to go through this at a high level. If we're going too fast, slow us down. If you want me to read every word aloud as you read it silently, we'll do that too. But I'll try to hit the high points, what I normally do, and try to keep it through 10 or 15 minutes. But if you do want me to stop, ask questions, I'd be happy to. The page beyond the table of contents, you go to cover table of contents. So the page beyond the table of contents is our audit opinion. This is truly what you engage us to do. It's a 2-page document, and it's a report from your independent auditors on the fairness of the financial statements. We issued an unmodified opinion, which is the type of opinion you want to have as a client. It simply means that the typical audit opinion is not modified because of any matters. We were able to obtain audit evidence to support your financial statements, and it's the highest level of assurance that we can give to you as a client. So it does, on the next page, on the second page, is a little bit of additional wording, just simply pointing out that we had required supplementary information because of what's required by the GASB. The GASB is the Governmental Accounting Standards Board. It's the technical board that sets the guidelines for performing accounting in the governmental world. So there are approximately 85 GASBs that are floating around out there giving us guidance on how matters should be reported. So, so that concludes the opinion.
Mr. Board,
yes, sir.
Excuse me, just, would you identify with particularity what pages you're referring to as we proceed through here?
Okay, that's why I said the page beyond the table of contents,
Well,
because it does not have a page number.
Well, I heard you say that.
That's here.
Yep.
Table of
Right, you're
con-
too far.
Where's the table? Is
Table
that,
of
beginning, open
contents,
it.
and then
I
the
thought
page
you-
beyond the
keep going.
table of contents.
The top says independent auditor's report.
Yeah. You go to the,
Backwards or
well,
something?
no, I don't know what I mean, this is how I got it.
did you get it back at this evening?
Yes,
Yeah,
well,
you
no,
just
well,
handed it.
yeah.
Bill,
Yeah,
here's one
that's-
that he had this evening, so you want to put
You mean this is a
Yeah,
different
looks more
one?
like
No,
mine.
it should
Okay,
be the same. But
well, all right. And
These are both different.
what do you have? here, Steve?
Communications.
At least I feel better than last, some just.
yeah, there's the one we went over.
Okay, right there.
This is the 2 pages we just went through. We went over this
Yep.
page and this page, so
Okay.
now we're starting here.
Are those different than what I have here? I don't
Yes,
know.
this, I don't know what that packet is.
That was the first letter that you went over.
Okay,
This is
Yeah, I
the
don't know what order you have.
Oh, you have your agenda and everything.
well, that's right,
together.
it's all, yes.
I don't have that stuff.
Okay, let's proceed,
Yeah,
thank you.
this
That
is
That was the
separate.
PDF that we used to put in council's folder.
We're at
Go
MD&A,
pick
is
this
that
up
where we are?
We are at the MD&A, okay? The MD&A is a document that's written by management. The intention of the document is to go over the financial activity of the municipality. It's required by a GASB, so it's municipality driven. Its intention is to go over the activity, hit on key financial events that have occurred during the year, financial highlights, if you look at the first section. And it requires that you talk about budget transactions that were significant budget fluctuations. It also requires that you go over an overview of the financial statement layout. And we read through this document for factual content, but we don't write the document, your management does. So we agree the numbers to the financial statements, but other than that, we ensure that it has what is required by the GASB in it, but other than that, it's intended to try to put into user-friendly terms and not accounting language what went on in the town during the year, so. And that's numbered with a Roman numeral system, and the challenge with us numbering pages sometimes is we get the ED&A at the last minute and we have to put it in, so we would have to renumber 80 pages based upon whether or not a graph was added or not, so we try to keep it. Yes, ma'am?
Rich, did you write this?
Yes.
It was very clear and very good. I liked it a lot. It helped clear up a lot of things for me. Thank you.
Thanks, that's actually the required format.
Oh.
It's supposed to be clear and concise and no
It was.
fluff or anything. so.
It was very helpful and informative.
Yeah, it isn't
Thank you.
intended to have editorial or can't take shots at funding agencies or the state or. So once we get beyond the management discussion and analysis, we get to page 1, is the first financial statement. In the governmental accounting standards world, you're required to have two separate financial statements on 2 different bases of accounting. And I'm also here to say that the GASB is considering modifying that and creating a 3rd basis of accounting. So if 2 isn't enough, a third may be coming in the near term, and that's actually the name of the new basis, near term. So that's probably about 2 or 3 years out, so stay tuned to that. Dustin's going to go through the financial statements for you, and just again, if we go too fast, please slow us down, but otherwise he'll try to hit the key points.
As Tim mentioned, there are 2 sets of financial statements in the first 12 or 11 pages of the financial statements. Page 1 and 2 are considered the entity-wide financial statements, and they use the economic resource measurement of accounting, also known as accrual accounting. So these financial statements essentially would be similar to the way a business accounts for things. Pages 3 through 6 are the fund financial statements, and these funds are measured on the current financial resource measurement focus, also referred to as modified accrual accounting. These fund financial statements are essentially how the town internally budgets and how their internal accounting system would agree to the dollar to these financial statements. So that is essentially how all municipalities internally account for things is under the fund accounting system, the current financial resource measurement focus, and then there are actually reconciliations that I'll go over in detail too that take you to the basis of accounting. The key differences between the 2 is the entity-wide financial statements include capital asset activity and any long-term liabilities such as the pension liability and the OPEB, or the other pension or other post-employment benefit liability referred to as the net OPEB liability on the financial
Or in most
statement.
cases, long-term debt bonds, which you currently don't have any long-term debt.
Correct. Then beginning on page 12 is all the footnote disclosures. So that's an overview of the framework of the financial statements. Now to move into some highlights, starting with page 1, the statement of net position. Total assets at year end of approximately $56 million. Includes $40 million in capital assets, which includes infrastructure.
So this includes all your assets except for your pension, all into one combined strip.
Correct. Total liabilities, approximately $4.5 million, includes $1.3 million in other post-employment benefit liability and the net pension liability of $2.2 million. I'll discuss both of those liabilities in some detail. The pension liability was a new item that came onto the government-wide financial statements last year as adoption of some new GASB standards. This would mark the 2nd full year in which that item is included in the financial statements. Net position at year end, approximately $53 million. There are 2 other categories called deferred outflows of resources and deferred inflows of resources. They relate directly to the pension liability. Moving on to page 2 of the entity-wide financial statements. Total revenues, charges for service of $1.1 million, grants and contributions, 1.8 million, and general revenues of approximately 12 million. General revenues also include, or predominantly, make up tax revenue and some other items, but the majority of that is made up of all different types of taxes that the town levies, including real estate, earned income, real estate transfer, local service tax, business privilege, and mechanical device.
And you'll see this statement starts out a little different than most income statements. It starts out with a column with expenses. It shows how the expenses are funded through charges of services, operating grants, capital grants. And then the top right-hand column shows the net expense over the revenues and fees that the town collects. Then that deficit of approximately $11 million gets funded through what Dustin was referring to, the general revenues. And you'll see at the end of the day, you had a positive change in net position of $957,000.
Okay, then moving on to page 3, this is where the government fund balance sheet starts. So this is the other basis of accounting, the second set of financial statements that's included within the financial statements. And here you can see there's the general fund, the transportation district fund, the capital improvement fund, and the other governmental funds. The first 3 are reported on separately because they are considered to be major funds of the town. Now, the major fund concept is based on their size. It's not the town gets to pick what those are considered to be major fund. If there's a criteria that has to be met in order for that fund to be a major fund, and then is reported on separately. Any other funds not meeting that criteria are combined and shown in the other governmental funds.
Which there's a schedule in the back if you want to see the detail for that.
Correct.
You can.
And
So all the fund information is included in this report.
Correct. The other governmental funds is made up of the highway aid and the street and water assessment fund. As Tim mentioned, there's a combining schedule included in the other information section of the report that shows the individual activity combined and then agrees to that particular total.
And then the general fund, you might call it your 01 fund. The transportation district is what, 05? 15. And then the capital improvement is the 18 fund.
The general fund ended total assets of approximately 10.5 million, total liabilities of 3.3 million, deferred inflows of resources. This is where we get into the concept of current revenue streams. So anything beyond a current readily available period is considered to be a deferred inflow of resources. The town uses a 30-day cutoff period. So anything that is expected to be collected beyond that 30-day period is shown here as unavailable revenue. On the government-wide financial statements, that entire balance is shown as revenue. So those two pieces are a key difference in another item between the government-wide and the government funds. Total fund balance for the general fund at year end is approximately $2.8 million. Moving on to the transportation district fund, approximately $2 million in assets, $125,000 in liabilities, unavailable revenue of assessments of $1.4 million, and ending fund balance of approximately $500,000. The capital improvements fund, total assets of $5.4 million, liabilities of $152,000, and ending total fund balance of $5.2 million. Other governmental funds, total assets $815,000, a small amount of liabilities of $843, assessments which include unavailable revenue of $39,000, and a total fund balance of approximately $76,000. Moving on to page 4. 4 is a reconciliation between the government-wide financial statements and the fund financial statements. So it will show here all of the items that are accounted for differently, with the largest item being capital assets net of any related depreciation. The second item being the taxes that are not available in the current period. referred to as unavailable revenue on the fund financial statements. Any loan receivable and assessments of $2.4 million, any changes in the net pension liability, and any long-term liabilities of $1.3 million, which include any unfunded post-retirement employee benefits. We started with the governmental fund balance, and we end with the total net position. Both of those items are found in the respective statements. Okay, moving on to page 5. Same format. General fund, total revenues, approximately $15 million. Total expenditures, $2.2 million. Other finances and uses of $3 million. A change as a decrease in fund balance of approximately $414,000 for ending fund balance of $2.8 million. Transportation district, total revenues $129,000, expenditures $5,000, other financing and uses of $125,000, a small decrease in fund balance of approximately $1,000 for an ending fund balance of $459,000. Capital improvements, revenues of $17,000 made up of interest, expenditures of $3.4 million, other financing sources of $4.1, for a net change in fund balance of a positive $716,000, for an ending fund balance of $5.3 million. Other governmental funds, $837,000 in revenues, approximately $2,900 in expenditures, uses of $836,000, for a net change of a decrease of approximately $1,700, for an ending fund balance of $776,000.
So at the end of the day, in your governmental funds, which are all your funds except for your pension, you had about a $300,000 positive change in fund balance over about $15.9 million worth of revenue and about $15.7 worth of expenditures, and the net difference being other financing sources and uses.
Page 6 is also another reconciliation between the two financial statements. This includes all of the revenue and income differences. You have any additions and depreciations of capital assets as the first item. You have any changes on any changes in any other items, including disposals of fixed assets, tax revenues, other post-employment benefits, any loans, receivables, and assessments, as well as any changes in the OPEB liability. Starting on page 7, this is where there's budget to actual analysis for all of only the major funds. So if it was considered, met that threshold, it had an adopted budget, and then that actual and budgeted variance is shown here on page 7, 8, and 9 for those funds being the general fund, the transportation district fund, and the capital improvements fund. Generally, all revenues were actually higher than budgeted, and most expenditures came in slightly lower than budgeted for all 3 of the funds. All positive things. So again, that's page 7, 8, and 9. Beginning on page 10, this is the town's fiduciary funds, which is made up of the pension trust fund, including both uniform and non-uniform pensions. But this only includes defined benefit pensions, not the town's defined contribution pension. The majority of this is made up of the uniformed pension plan. A very, very small portion of it is non-uniformed employees. I believe there's 2 employees included in the non-uniformed pension plan.
Both retired.
Yeah, and they are both retired, so 2 people are receiving benefits. The other is the agency fund. That fund is, money is held by the tax office during the course of their tax collections. So we have here the schedule of assets and liabilities for those particular funds. Page 11 then shows the change in the pension trust fund. It goes through showing the Commonwealth state aid allocation, as well as any employer and employer contributions, as well as any investment income and increase in fair market value of investment values. It's then subtracted by any benefits paid to participants and administrative expenses. Overall, the change in plan net position for the pension plan increased by $365,000, predominantly made up from market gains. In the prior year, you have a loss. That's due to some significant market fluctuations in the value of the assets. Ending net position for the planned trust funds was $14 million. Okay, then moving on to page 12, this begins the footnote section of the financial statements. Footnote 1 is the summary of significant accounting policies. This goes through in some detail. It also kind of reiterates the framework and the concepts behind the financial reporting of the town. It follows all of their significant accounting policies. As Tim mentioned, there were no significant changes in accounting policies from the prior year. The footnote is pretty lengthy, and it kind of covers all areas of significant accounting policies, including revenue recognition, budgeting, deferred inflows and outflows, capital assets, and so forth. Page 20 and 21 goes into detail of adopted pronouncements that are set by the GASB. There were 4 adopted pronouncements, none of which had any significant impact on the town. Either it was minor additional footnote wording, or it purely wasn't applicable for this particular year. There were no criteria that met an adoption for those particular standards. Page 21 shows there's some remaining ones that possibly will have an effect on the financial statements, and also discloses the year in which they become effective. GASB statement number 74 and 75 being the 2 that we also included within our management letter, which we're just recommending that the town be in contact with its actuary, because the same concept with the pension plan and including certain footnote disclosure is going to be now required on the town's other post-employment benefits plan. So in the past, that information beyond what's in these financial statements was not required. Beginning in 2017, some significant footnote disclosure will be included. Then the following year, there'll be some financial aspects that go into the face of the financial statements, similar to the same format in which the pension amounts went on in the prior year, and then the footnote disclosures in the year before.
And it'll probably increase the liability on your balance sheet by about $500,000 to about $1.8 million. So,
Okay.
and the main difference between OPEBs and the pension, OPEBs you haven't been necessarily funding, whereas the pension has a much larger liability, and you have assets that are being held in the pension trust fund that you can use to pay off the liability. So. We would see, we do about 250 municipalities. I'd say half of them have OPEBs, and I would say about 5 or 6 of them are actually funding their OPEBs. In other words, setting up a trust and putting money into the trust. So it's very uncommon at this point where the OPEBs are funded. When I refer to OPEBs, I mean other post-employment benefits. Usually healthcare is the main one that causes liability to occur. But any benefits sometimes can be disability insurance, sometimes it can be life insurance as well too. So next.
Our OPEB is for the police department by their contract. It's for their reimbursement for health insurance until they're 65. They have to show us that they have health insurance that they've purchased. And If they show us that, then we pay up to the amount that they retired at. We're providing health insurance.
That is correct. I was just gonna mention that
Sorry.
those benefits are only for uniformed employees. They are not for non-uniformed employees. Okay, moving on to page 22, the second footnote, cash equivalents, and investments. That describes the town's cash balances and pension trust funds. One of the new adoptions during the year was at the bottom of page 23, there's a new concept of valuing the investments that are held by the town in different levels. Level one being that it's not a very uncommon investment. They can easily be valued by going out to
It's actively traded in
Actively
the public
traded.
market. So you can go to Yahoo and find out what the value is at any given point, so.
in level three being an unobservable input, often would be such as derivative and hedge funds, commonly could be more riskier type investment. The town does not have any of those. The majority of all of their funds are in level one inputs, with just a small amount of corporate obligations as level two, because bonds are not actively traded in the same way that stocks are. Footnote 3 goes on to discuss the property taxes levied at the beginning of the year, as well as the millage rate. It also discloses that of the entire levy, 98.6% of that tax levy is collected in 2016. I think over the last several years, as far back as 10 years, that high 90 percentile has been the common trend. Footnote 4 shows a roll forward of the capital assets. You begin with the capital assets in the beginning of the year, and then any additions and disposals, and your ending total capital assets, which also includes the town's infrastructure. This information is shown on the government-wide financial statements, and will agree exactly back to those numbers included on that statement. Also discloses the depreciation and how it was allocated to the various cost centers of the town, of which is allocated by for either the building or the equipment is, or who is using those particular assets, as essentially how that depreciation is allocated. Moving on to page 26 is footnote 5, pension plans. As I mentioned, this is actually 8 pages long. It used to be probably about 3 or 4 pages a few years ago. Your OPEB plan will essentially mirror these same type of disclosures, and we'll begin to add that information next year, and then the actual impact on the financial statements will come in the following year. At the bottom of page 26, it shows exactly how many participants are in the plan. As I mentioned, there were 2 in the non-uniformed employees plan and 27 receiving benefits in the police plan. Excuse me. It goes into detail for both the non-uniform and the uniform plans, and discusses any retirement benefits that are available to those participants that meet the eligibility requirements. Moving on to page 29, the contributions and funding policy. The concept between the past and the current with these particular standards, what's shown on the financial statements now is kind of, right now, what is the total liability? Essentially, if all of your liabilities become due, what is the difference between what your plan assets are and the total liability? That's what the net pension liability is. So if you essentially would have to pay out to all participants, you would be short by this liability. However, that doesn't change.
And that is if everybody lives as long as they're supposed to, according to an actuarial table.
Correct. So it's all a big estimate. This does not change the way the plan is funded. The town every year makes its municipal obligation that is calculated by the actuary. So what that's saying is that the actuary is estimating that if these deposits are made each year, when everyone that is included in the plan essentially has all of their benefits paid for, there will be enough left in the trust to cover all of those liabilities.
And the other big variable to that is the earnings in the plan. If you look at the top of page 33, you'll see you're currently using a discount rate of 7.25% for the police plan and 7% for the non-uniform plan. So if, and that's how the liability is measured at 2.2 million. But if the market were to go down by 1%, you'll see that the liability would be about 3.9%. But if the market rate would go up to 8.25%, the liability would only be 700,000. So the market can fluctuate this liability greatly, your rate of return. So, and remember, it's a long-term rate of return. It's not what happened last week or today.
Moving then on to page 34, the defined contribution plan. So this essentially covers all other individuals, all other employees that participate into the defined contribution plan. It also discloses any contributions that were made by the plan and the employers.
And that's not shown in this report. There are some defined contribution plans that are required to be shown, but yours isn't required to be shown based upon the level of control that you exercise. Once you pay the money's gone, and that's the end of the story. So, your OPEB's post-retirement plan?
Yes, the following footnote, footnote 7, then goes into detail of the OPEBs that we continually have been referring to. It discloses who's eligible for those particular post-employment benefits, and it also goes on to describe the funding policy, commonly referred to as a pay-as-you-go funding policy. So as those expenditures are due to those participants, you pay them. There's no trust in which is held netting against that liability. You just pay the particular participant for those amounts due upon their.
So if you look at the top of page 36, you'll see a little chart that walks you through this year's calculation. The annual required contribution, according to the actuary, is you should have put in $195,000 to fund the plan. There are a couple other adjustments to that, and it nets down to $173,000. You actually made contributions of $9,800, but you didn't really make contributions. You paid the current liability as it became due. And so at the end of the day, your actual liability went up $163,000 because you should have put in $172,000. So under this funding method over a long period of time, your total liability would get to being the total liability of the plan. This GASB standard is going to go away, and the new one's going to come next year. It's going to require that you not amortize. You see the amortization that's going on at the top, and it actually recognizes the whole liability. Right now, your liability is about 1.9 million, and you have about 1.3 million on the books. So you'll take a big jump as a restatement during the first year. So there's about a $1.9 million liability there.
I'm just going to just touch on footnote 11 on page 38. This describes the transportation district, gives a background of the project, and also discloses approximately 1.4 million of assessments that are due and being paid over a 20-year period by the particular beneficiaries. The 1.4 million is also shown as an unavailable revenue on the fund financial statements, and the entire receivable is shown on the government-wide financial statements.
So
of that 1.4.
it's considered to be unavailable to be able to pay today's bills, but it has some future asset to you. That's why it's termed as unavailable.
Okay, then moving on to page 40, this begins the RSI, the required supplementary information. Page 40 and 41 includes a same table that's in the financial statements, however, is now in a comparative format. So you can see from 14, 15, and 16, the changes of the pension liability. It first starts with the non-uniform employees pension plan on page 40. Then page 41 is the same exact table with the police plan. On page 42, another schedule. This is essentially showing what the town was required to deposit into the plan based off of the actuary's estimates, and shows that there were no deficiencies or excess. Whatever the actuary calculated as the minimal municipal obligation is essentially what was deposited into both plans.
This will eventually be a 10-year schedule, but you build it as you go.
43 and 44 discuss some of the assumptions that are used by the actuary to determine these liabilities. There were no significant changes to benefits in 2016. There were a couple changes in assumptions during 16, which included a change in the investment rate of return. It was reduced from 7.5% to 7% for the non-uniform employees plan, and was reduced from 7.5 to 7.25 for the police plan. And also a mortality assumption table was updated from the prior actuarial evaluation. The town has a evaluation done every other year for their pension plans. That valuation is then updated annually for any changes in essentially change in assumptions, as mentioned, as well as any change in fluctuation of investment gains or losses. Then moving on to page 45, there's the liability that Tim was referring to for the post-employment benefits other than pensions of the $1.8 million as the total liability. So in the future, that essentially will be what the liability will be shown as. Of course, we'll update from year to year. The town is only required to have a evaluation done every third year due to its size. So it's considered to be a small plan, therefore it can be done every third year. Moving on to page 47, we have just some more detailed budget to actual analysis. The supplementary information essentially is not required by the financial reporting framework, but is in relation to the financial statements. So these totals will agree and roll up to the financial statements, in which are considered to be the basic financial statements. Those include some more detailed for the government fund. It also includes the combining schedule that we referred to and the other governmental funds on page 49 and 50. And also includes budget to actual analysis for those two other governmental funds on page 51 and 52. A combining schedule is also included on page 53 and 54 of both the pension plans, showing a separate fund for the police and a separate for the non-uniformed employees plan. And that concludes the audited financial statements.
Okay, thank you. Anyone on council have questions?
One other thing we did issue was the management letter. So within this management letter is a one-page document. We are required to report any deficiencies in internal controls. We do not design procedures, nor are we providing an opinion on the internal controls. However, if there's anything that we consider to be a material weakness or a significant deficiency in internal controls, we have to report those to management. There were no deficiencies that we came across during the course of our audit. That doesn't mean that there isn't any. It means that during the course of our audit, we're not aware of any.
So what did you call that? I'm sorry, you called this
The management letter.
the management letter?
Yes,
Okay, I'm
correct.
sorry. I didn't-
So what we included on here is just some advisory for the new up-and-coming OPEB financial reporting standards, in which there's going to need to be some communication with the town's actuary to ensure that the information is provided to them and that their reporting on their behalf can be done accurately to meet the standards. So no internal control weaknesses that we're reporting in this letter, just some advisory things for an up-and-coming standard. And then that concludes all the reports.
Any comments from council or questions? Thank you for your very thorough report and your explanation.
I'd just like to offer, anytime anybody have any questions, we'd be happy to talk to you about the questions. We certainly serve the board. That's why the audit reports are made, addressed to the board of directors, and we'd be happy to answer any questions you have throughout the year. You can reach us off of our website, contact information, or off the letter as well. So thank you and have a good evening.
I have one
Yes, sir.
quick question. The very last paragraph, in order to prepare for these changes, we recommend a designated individual from the town review these statements.
Sure.
Am I correct in assuming that person will be Reach?
Correct. Yeah, and we know that Reed has been pretty active about this and attended seminars. We also put on seminars for our clients. We'll be doing some in December of this year. We'll focus in on this too. So Reed often attends those seminars as well.
Thank you.
Thank you. Our next point on our agenda is to discuss Assistant Town Manager, Finance Director Regis J. Ebner Jr.'s memorandum about the town's response to the Access McCandless May 21st, 2017 posting concerning its right-to-know requests and town accounting procedures. In particular, those pertaining to the town's Heritage Center with the town's independent auditor, Marr and Dussel representatives. Reach?
Yeah, I'm not sure I have much more to add from my memo. It's just that there's a posting on Access McCandless, and a lot of people believe what they read on Access McCandless. In this case, I don't believe the posting was accurate. It called into question the competence and the appropriateness of myself and my staff's handling of our accounting and right-to-know requests. So I bring this to council's attention so that while our auditors are here, if you have any concerns about the way we account for things, you can ask them. If you have any questions about how we handle right-to-know requests, I'd be more than happy to answer them.
And if council looks at the back of the first page from Reach, the request for right-to-know is there, and all of the things that were asked for were given. Comments from anyone on council? Thank you, gentlemen. Moving to number 3, report on town defined benefit police pension fund performance for the first quarter of 2017 and the months of April and May 2017 in less detail, and alternatives for investment management as prepared by ANCO, Town Investment Consultant. Before I turn this over to Justin, I'd just like to say all of town council are the fiduciary for the town police pension plan, which means we have oversight of the plan's management. We have an investment manager who invests police pension funds under an investment policy statement that provides guidelines for the investment manager to operate under. We utilize an investment consultant to offer recommendations to the investment manager's performance. Justin Lauber of ANCO, our independent investment consultant, was directed by council at our April Finance Committee meeting to give an update, on the performance of Manning and Napier, our investment manager, and present plan options available to council tonight. Justin, may I turn this over to you now, please?
Good evening. I think Joanne did an excellent job sort of summarizing sort of where we're at. And I believe the agenda indicates all the items that we will cover today, including the first quarter performance report, as well as 2 monthly updates, and then that sort of portfolio options discussion that we were directed to prepare at the April meeting. And I just want to start before we look at the first quarter report. I spent a lot of time at the April meeting focusing on the last 3 years of performance from the investment manager, Manning and Napier. We're fairly critical of their performance, but I don't want to, despite that focus on the 3 years, I hope it's not lost that the sort of history of the police pension plan since Manning and Napier was retained back in April 2003 has been quite positive. So just as of May 31st of this year, the plan has an annualized return of 8.12%. And you may have heard the auditors reference the actuarial assumed rate of return, or the return assumption being 7.25%. So 8.12% means your investment manager and the plan as a whole is exceeding that return assumption, and that is always a good thing. That is truly a long-term measure. It's what helps us, fund the obligations to the members, to, in this case, the police men and women. Also, when you're able to exceed that return assumption, it also helps put less stress on the necessary contributions to get the plan to fully funded. So in terms of probably the most important long-term measure for the health of a pension plan is its ability to meet that actuarial return assumption, and this plan has. Despite the recent, I would say, underperformance from the manager, they have helped this board, the plan as a whole, meet the longer-term objectives. So with that said, I'm going to be looking at first quarter performance in the report. And I'd like to start, I'm only going to cover a couple pages. I'd like to start on page 11. Yes.
I'm sorry to interrupt you. I wanted to make sure that I understood. You were saying that since '03, they have had good performance, and then it's just been the last, could you repeat that, what you just said?
I think the stretch between 2014 to the end of 2016 as a whole was probably the weakest performance we've seen from the investment manager. Prior to that stretch, they had been doing very well, and even with the sort of some of the underperformance from recent calendar years, the long term. So if we look at since 2013 or 2003, I apologize. So that 14-year period, it has still been. They are exceeding expectations over that full long-term time period, despite some of the recent issues.
We are at this time exceeding.
Since they have been retained, they are outperforming the benchmark, as well as the plan as a whole is doing well relative to other public pension plans in terms of its returns, and again, exceeding the actuarial return assumption of 7.25.
And the reason I asked that is because I was looking at this other statement that we got a couple months ago, and it says that they were underperformed over the current quarter, 1 year, 3 year, 5 years, and 10-year time period.
Right, so that would have just been probably, just in the, looking at their, over that given time period, which changes every single day. So each quarter's experience is going to change those, trailing observations. But at that report, which I assume was the fourth quarter 16 report, that would have just been, that language would have just been comparing the performance versus the benchmark. So if they had returned over that 5-year period, 5.5%, the benchmark was 5.6, that would have been considered underperforming just in the report for purposes of that, for the time period comparison.
Were you referring to page 10?
I am, yeah.
In which, but is this the current?
Previous, the
10.
previous quarter's report. Which page 10 with the recorder?
Town of McCandless,
Yes, for March.
page 10.
In March one.
Yeah, so page 10 in the report would just really be sort of the summary. And the way it's set up is the recommendations come more in the sort of last paragraph, but you can see there is, in the first paragraph, yes, there is comparison over, so the total fund currently outperforms policy index returns over the 1-year time period, trails over the 3-year, 5-year, and 10-year time periods. However, performance over 5 and 10-year periods is essentially meets policy index returns. So you can see the, just a fraction of underperformance over those time periods. And then if you were to look on page 8, at the very top right, the very first line on the far right, you'll see inception date, so that's when the manager was retained, April 2013, and you can see it as of March 31st, the performance there, 8.05% versus 7.30% for the policy index. And then that 27 that would be in parentheses there, that would be sort of the relative performance ranking compared to other plans. So 27th would mean that this plan's return, the manager's return over that time period, in this case inception, would be outperforming about 75% of other return observations. Other plans' return observations. I'd like to start then on page 11, and then we'll go back to page 10, but this will just summarize the overall performance, looking at a variety of different time periods. And what I'll just start.
Is there something, Bill? That's right.
Did you just hand this out?
I thought they were at the.
It's on, I asked for a hard copy for the readings. It's on screen, I'll gladly share.
No.
All right, if everyone is on page 11 then of the quarterly report, I'll just start by just the first quarter return for the plan, 6.55% versus what the index return of 3.63. So almost 3% outperformance for the during the first quarter for Manning and Napier. So that's a rebound after that difficult fourth quarter of 2016. So an extremely strong first quarter for the manager and the plan. And before looking at any of the other, if it's the trailing time periods on this page, if you wouldn't mind moving a little bit to the right-hand side of the page where we have, we're showing you the last 5 calendar years of performance. I'd like to just quickly sort of summarize what, so here we're just looking at on a calendar year basis, the return for the plan versus then the policy index, and then that line says median would be the median return in the public plan universe. But if you go to the far right and we look at 2012, so we start with the last 5 years, you can see a 13.68% return, which was about 3.3% better than the policy, so a strong year. That was followed up by about 3.75% outperformance in 2013. So 2 very strong years on this calendar year basis. Then 2014, you can see some underperformance there, about 2%. Not surprising. A lot of times we see managers, after a very strong return environment, they'll oftentimes give up a little bit of gains relative to, say, a benchmark. But still, that was 2014. And then you can see the underperformance in 2015, which was a difficult year for Manning and Napier. And that was actually marked the first time since they've been on this plan that they've actually had consecutive years of underperformance. So in the past, when we had seen Manning and Napier perhaps underperform over a short stretch or for a year, typically they were able to rebound pretty quickly and start to outperform again. So that's what sort of caught our attention, and that's why we just mentioned that 2015 was interesting because it was the first time we haven't seen them bounce back pretty quickly, and so we just brought it to council's attention. We weren't really recommending anything at that time, just to keep an eye on them and see how 2016 would transpire. We expected that it could be a good year for Manning and Napier. And actually, to start the year, it was. And if you look towards the bottom of the page, you'll see that it says comparative performance. So this is just looking at the last 6 quarters of performance. And so towards somewhat in the middle, you'll see one quarter ending, and it says March 2016. So that would have been the first quarter of 2016. You can see a 1.65% return during that quarter. Now that was slightly behind the policy index return for the quarter, but then you can see the subsequent quarters in the year of 2016. So the second quarter, that would be June. You can see a good quarter from the manager, and then the third quarter, that would be September, a very strong return relative to the benchmark, on an absolute basis as well. So actually, through the first 3 quarters of 2016, Manning and Napier was outperforming the index by 1.25%, and the police pension plan was actually sort of in the top decile or top 10% of returns year to date through the first 9 months of the year. The median plan return was at that point in time 6.12%, and this plan had returned 7.93%. So it looked like 2016 was going to be the rebound that we were expecting, and it wouldn't be, I think things would be, sort of the assessment would have been a little bit different if not for what was that very poor, difficult performance in the fourth quarter. Certainly, some of the equity holdings of Manning were not quite positioned for how the capital markets sort of reacted in the fourth quarter. So really, the only stumble last year came at the very end of the year, but unfortunately that led to what was in total underperformance in 2016. So that's one of the reasons for some of the harsher, some of the criticism of performance is the third consecutive calendar year, but really it was the fourth quarter that was the issue. But what you'll notice is the capital markets, especially with equities, have significantly reversed in the fourth quarter. So what sort of wasn't working for the manager during the fourth quarter has worked very well in the first quarter, and that's how we see this tremendous rebound in overall performance for Manning and Napier in the plan, with our first quarter return again being 6.55%. With the index up 3.63%. So that's a bit of the sort of performance history. I think if we talk about sort of trailing returns, this 3-year return will be, probably under the policy index for a little while. It will take time to work off underperformance, but if this trend continues that we saw in the first quarter, and I do have some updates, that is what we want to see with your investment manager. And again, through March 31st, you can see, 5 and 10-year returns being very close sort of to the policy index. And again, what's not captured on this page is their performance since inception, which again has been fairly strong. So I'm going to then, if we just flip the page back one to page 10, and I know we can sort of all read, and but really I want to get to, we have a few other items to cover. I just want to get to sort of the recommendation as of the end of March and where we stand today, and that's all sort of contained in that last paragraph on page 10. So there's a little bit of summary information here, but we did recommend in 2016 to closely monitor the performance of Manning and Napier after they, I think, had subpar performance in 2014 and 2015. Hence our, at that time, we wanted to certainly no changes, and the history was still strong. It is still strong, but it was just bringing to your attention. We've never seen 2 years of underperformance before. And in fact, as we talked about when we looked at those 2016 quarter-by-quarter returns, performance had improved throughout 2016 prior to the fourth quarter. The plan, Manning and Napier, was outperforming by 1.24% through the end of September of last year, and the plan ranked in the top decile of plan returns. So essentially, a return experience that was better than at least 90% of other pension plans over that time period. So a very good start, or first 9 months. But unfortunately, on account of the fourth quarter performance, the total fund ended up underperforming for the year by 2.4%. Again, that marked the third consecutive calendar year of underperformance relative to benchmark in peers. That's when we recommended, town council think about, whether it was time to pursue diversification or potentially reduce asset exposure to Manning and Napier. But at this time, what I would say, in light of the significant rebound that we saw in the first quarter, and to an extent that's continued in April, in May. So what we saw in the first quarter, at this point in time, we would recommend retaining Manning and Napier to manage all assets, but with continued close monitoring. I think it would be good to have Manning and Napier present, give a good update at a future meeting. But as of this time, with what we've seen, we think it would be prudent to allow them a little bit more time, especially if we are about to see that recovery that we were hoping to see a little bit earlier. But if we get that portfolio recovery after that little stretch, or after that stretch of underperformance. And what I would point out that their approach generally has led to a variable return pattern. So they don't always look like the index or like the peers. They do go through stretches of both short-term underperformance, but as well outperformance. And I think at this moment, it's prudent to see if we can get this outperformance to continue for another quarter or two and actually start to build off of and see if some of their positioning that hasn't worked perhaps 2 years ago is all of a sudden working in this market environment. And the last thing, we did talk about what are the options under a diversification. So we did put together sort of a one-page summary outline to review potential options, and diversification can be pursued at any time. It's not. It is something that it doesn't have to be focused on was it a good quarter or not for the manager. So we do have that discussion guide, but currently, as of, March 31st, the recommendation at this time would be, no changes in light of what we have just seen.
And not even in the international area?
Well, because of the approach with the manager, we can't really, they have all assets in sort of a balanced portfolio. So, we would have to change sort of the, you would have to change sort of the strategy with Manning and Napier in order to get away from international equities. So it's just really the structure with the Manning and Napier strategy that makes it, can make it a bit difficult to sort of separate just individual components. I will say I think the international equity has rebounded a little bit recently. The domestic equities have done very well. And again, the international segment is the smallest, allocation of their portfolio, usually at about 10 to 15%. So but yes, I mean, if you look at they're lagging over 5 years, sort of the index by about 60 basis points. So the underperformance on the international component, is somewhat slight, but there have been some recent, much like the domestic equities, the last 2-3 years have not been a great environment for their international portfolio.
So what you're suggesting is that we continue to monitor them, but my thought is that possibly in August or September that we have an additional report so that we can see how they're doing, so that it won't be a long period of time.
Yeah, and and certainly it's the schedule that works best for this group. But ideally, I think what we've seen over the last few years, and also where we're at today, we still want to take this. Not necessarily it has to be on a quarter-by-quarter basis, but I think as frequent that we can have these updates and interactions, not only with our reports, but also with the investment manager. So if there's August or September, I would be happy, and I'm sure Manning and Napier would be able to come out and give a more either in-depth or just an update to see where we're at. Because again, we saw the fourth quarter and we've seen the first quarter, so this changes. This is changing quickly, So hopefully we have this performance continuing. That'll certainly, I think, lessen some of the concerns. But I would agree with August or September for another meeting.
That's what I'd like to see happen, so we would have Toby contact them and you to set up when you come back in.
David's here.
Yep, no.
We'll make sure August 14th is, I think August
Okay.
14th is the finance committee.
Yes,
meeting,
I'd
the
like,
second
I'd
Monday.
like that to happen.
And check schedules.
If there are no further questions on the quarterly report, I'll give you just a quick update on more recent time periods. And there's going to be 2 handouts that look virtually identical. I'm going to start with the one that is April, and you can identify this at the top right of the page. It'll say performance update as of April 30, 2017. And just really a quick summary here, but you can see not only the total fund performance on this page over different trailing time periods, but also just the different segments for the Manning and Napier portfolio. So we had the good first quarter from the manager that continued. We'll look at the total fund that continued for the month of April. So that's what that month is, just the single month of April returned 1.6%. The policy index of 1.02%, and other plans 1.17 was the median return. So building off of the first quarter in April, and you'll notice domestic equity segment has really been driving a lot of the performance this year, and that continued in April. So 2.81% for their domestic equities, whereas our 2 equity benchmarks The Russell 3000 and the S&P 500 were up a little over 1%. And you can see on the year-to-date basis with domestic equities up a full 15%, with the Russell 3000 up 6.86. So significant, we've seen a significant turnaround in performance with the domestic equity portfolio in particular. In fact, all these segments, domestic and international equities, as well as the fixed income there, are outperforming over the year to date. And if you go back up to the total fund, our updated April return through April, 8.26%, which is well ahead, 3.57% ahead of a policy index return, and well ahead of what other plans have returned. So it has been a very strong year to date. And then you can see some of the trailing return observations. Again, I mentioned in the quarterly report, the 3-year, it will take time for that number to sort of look better versus the benchmark. So you can see, 2.1% or so underperformance there, but the 5 and 10 year, so whereas they were slightly behind as of March, when you look at it as of April, if you look at the 5-year, the performance is now slightly ahead of the policy index. So that just shows you that these return comparisons do change depending on the time periods that you're looking at. But then again, I think the key numbers to look at on the far right, the since inception return, again, since Manning and Napier was retained 8.12% annualized, and that compares to 7.33% for the policy index, and again ahead of the assumed or the interest rate assumption used by the actuary. Just some other quick information. So investment gains have been about $1.14 million this year. So we're just shy of a planned market value of $15 million through April, $14.87 million. And I think this was something that Manning and Napier talked about at the April meeting with respect to their asset allocation, but they were getting slightly more conservative. By that I mean just lowering their overall equity exposure versus the policy index. They believe the equity markets are fully valued, so they're getting a little more conservative in their approach to protect the plan if there is a correction in the equity markets. And you can see that lower right, we have the allocation for the pension plan, and if you were to add up both domestic and international equity exposure, it would represent about 46.5% of the overall asset allocation. So again, this is shifting to as of right now, based on what they're seeing, they have shifted to a slightly more conservative allocation. And then there's also a similar update. It was still as of May 31st, and again, you can identify that on the top right-hand page. And the other thing in the lower left, this is still sort of a preliminary information. Usually things are finalized a little bit later, but there should be no significant variance from what you're seeing now and what will actually be finalized. So the month of May, 1.21%, which was more or less in line, a touch behind the policy index, 1.28%. So they didn't really give up much in terms of the relative performance. And again, they added to our absolute return experience for the year, bringing the year-to-date return to 9.57% versus 6.03% for the policy index. And again, with the additional investment gains for the month of May, the planned market value now just slightly over $15 million. And then again, you can see the inception return observation is now on an annualized basis. So this is per year over this time period, 8.16%.
So what's the annual rate of return?
So it's a return. So it's not a cumulative. It's broken down into just on an annual basis. So if you have a 20% cumulative return over 2 years, it'd be annualized, would be a 10% return.
So what is this?
So this means
what's the percentage are we making on our money?
This means
last year and this year so far.
Well, last year wouldn't be 9.82.
Yeah, so last
One
year,
year's performance is
Yeah.
9.82 return on your money, right?
so last year in terms of calendar year, the plan had a return over those 12 months of 4.22%. Over the first,
Just give me for the whole year, because we know they did great in the beginning and not as good at the end. What was the total for the year?
for the calendar
For
year,
the calendar year last year, what was their rate?
4.22%.
4.22%. And what are we on schedule for this year?
Well, through the first 5 months, 9.57. So if there's no change in the markets, it would be a 9.5% return.
Okay, so it's much better than
Yes,
last
this has
year.
been a much better year.
So you mentioned point out the 15.003 market value was a 531 at the bottom, the preliminary number at the bottom of
Yes,
May
yes.
31st. And am I correct, that was compared, that should be compared against the 3.9, the 6/1/2014 number, is that what you were comparing that against?
I
The growth
I wasn't
of-
trying to make a comparison with the market value. I was just commenting this is the current planned
Oh,
market
okay,
value.
I got you.
And there's a little bit of information then on the lower left-hand side, which just shows you over different time periods. So year-to-date, you can see the a net cash flow, so money going in versus out. And then there's the pure investment dollar return. So that is 1.322 million year-to-date.
Toby, what kind of contract do we have with Manning? Do we have a contract with them for 5 years or 2 years, or what's our?
No, there's no set time period.
Okay, so we don't have a contract with them, okay.
Are there any other questions related to just any of the reports or the two updates in terms of returns? If not, then I would like to follow up on the conversation from the April meeting. There should be a one-page handout just outlining at the top right. It says portfolio discussion and the summary of plan options, in which there's 4 different sort of possibilities or overall. So I just wanted to cover these just so you know what the options would look like if we were to diversify, or if we were to make no changes, which is our very current recommendation, but that could change certainly in the future. But so the first is simply, again, no change, and to continue to closely monitor the investment manager. And again, this is to really emphasize the longer-term performance over some of the more recent performance issues. And then you can see some of the bullet points being outperformance versus its policy index since they were basically hired or retained in April 2013. The annualized return of 8.16, again ahead of the assumed rate of return. And then there's some comments about the rolling 3-year return observation. So we mentioned that currently they're not meeting that index return over 3 years. But if you looked at the history of sort of 3-year return observations, they would be outperforming the index in 78% of those observations. But again, the recent observations have been trailing. On a similar sort of basis, if you looked at them relative, the returns for the plan relative to the median public plan return, this plan would outperform the median return in 75% of those observations. Again, trailing, for the last several 3-year return observations, but prior to March 2015, which is where this this stretch, we were sort of in the middle of this stretch, the pension plan had outperformed the median public plan return over 35 of 36 rolling 3-year return observations. So that's actually an indicator of the historical strength of the plan, and really it's been the last few years that has sort of changed the, I think maybe the conversation a bit, but almost over every single return observation, this plan was doing relatively well compared to other plans. And then you can see some of the statistics if we looked at it just over a 5-year return. So, I mean, ultimately we recognize that all managers, any strategy will go through performance cycles, and hopefully for everyone that we are, Manning and Napier is sort of pulling out of that stretch of underperformance, and because there could be potential upside that we've seen so far in 2017. I don't want to make any changes. That's why we're recommending no changes today, just because I don't want to give up any of that potential upside if this is sort of Manning and Napier's themes that were not working are working going forward. But then certainly understand the risks of just a single manager. It's really when they do well, it's great, but if you only have one manager, if they struggle, you can feel it a bit. So the next two options are probably they're somewhat related, but so the first would be you could retain Manning and Napier in the current strategy, but simply reduce their asset exposure, so they wouldn't have 100% of the assets. And what we would do is just add some complement manager strategies that would be focused more on distinct asset classes and pursue diversification that way. So to Greg's comment, what about international equity? Well, what this approach would look like is you would simply wouldn't change the Manning and Napier strategy. They would still have that sort of balanced approach with that asset allocation ability, but they wouldn't have all the assets. So we would look to add these complement pieces, one of which would probably be a manager to focus strictly on international equities. And then you would have a piece that would focus strictly on domestic equities, and then a piece to look at probably fixed income. And then item 3, I'll get into in a minute. But then the second bullet point for item 2, again, so this would retain this approach. You would keep a manager that had the tactical asset allocation control over the portion of their assets. But then the other assets would follow more of a long-term strategic allocation, and we would target an allocation for each of those pieces. So, for example, Manning and Napier could have 50% of the assets in that sort of their tactical strategy. Then you would have a separate, say, domestic equity manager with 25% of assets. You'd have an international piece with 10%. And then 15% to a fixed income manager. And those sort of managers are only responsible sort of for their recommended allocation. So they wouldn't have any control over allocation. If it was an equity manager, they would just focus on equities. They wouldn't be investing or even be permitted to invest, say, in fixed income. Whereas Manning and Napier, that strategy has a lot more sort of flexibility. And then the third would be somewhat similar, but it would just be to look at perhaps all the entire pension trust and get rid of any sort of manager with sort of tactical allocation control or a balanced manager, and simply replace sort of what I would say the single manager approach. And again, what we would do is utilize different investment managers that specialized in distinct asset classes. So you would have a domestic equity manager, like 1 or 2, 3. You have an international piece, and then you had a fixed income piece. And so you would have each manager responsible just for their select asset allocation. ANCO, we would be the ones responsible for making the recommendations to council with respect to the investment manager selections, as well as the retention, and then ultimately any replacement. We would be the ones sort of making those recommendations, and any manager that was recommended would have to meet sort of our due diligence requirements from our research group. So we have a research group made up of 11 dedicated people. They do nothing but interact with investment managers. in debt investment strategies. It's a very lengthy, it's sometimes a multi-year process for a manager to go through all of the due diligence, but if they succeed from meeting our research group's criteria, they will then receive ongoing monitoring for that group. So sort of if we were if we were to add any new pieces, whether it was under scenario 2 or 3, you know, we would step in and make sort of more specific recommendations, and we can show you sort of the specific manager sort of options. But again, under approach listed in 3, you would not have a manager, there would be no one manager that has the ability to allocate tactically amongst the different asset classes. So when I mentioned that Manning and Napier intentionally gone slightly more conservative relative to the policy index in this environment, you know, you would sort of lose that ability because you would follow sort of a strategic long-term asset allocation. And again, we would work with you on sort of selecting that allocation. But again, no one manager would be responsible for the entire pension trust. The managers would just have only discretion over their sort of individual sort of asset allocations, and we would be dividing up the pension assets into sort of different sort of investment buckets, so to speak. And then lastly, you know, there is always the possibility, if you do like this sort of one manager approach, and you like the idea of a manager having asset allocation flexibility, but for some reason you don't want to continue to utilize Manning and Napier, we would assist you. You know, if you wanted to conduct an RFP, and we would help you review, you know, any responses. But under this scenario, we would not we would not approve or make a recommendation for a balanced manager, since our sort of recommended approaches would be are listed above. But you know, we want to work with council. If that's the direction they wanted to go, we would help you with that. But we would not make a specific sort of recommendation as to which one of the responses or to choose from. And in this approach, typically it is a little more intensive in terms of time and resources, but you know, that is certainly an option that we'll work with the group if that's the direction they want to head. But as of right now, the recommendation is for no change. That doesn't mean that, you know, that doesn't change on our end in 3 months when we meet again. But this is just outlining the directions that the plan could head in the future.
Any other questions from council?
I just have one question. With respect to dispersing the responsibility for investment over substantive areas, so to speak, international and so forth, with different managers, does that have an effect on the fees that are charged for the plan?
Sure.
Yes, and I sitting here, I can't tell you if the overall cost to the trust would go up or would go down. It would impact fees.
Wouldn't you expect them to go up if they've got multiple managers responsible for these different
It is.
funds?
It is possible. I mean, what I would say is every manager has a different sort of fee schedule. So, depending on if that approach was followed, you know, it could end up being a little bit higher. It could be, you know, lower than we're at with Manning and Napier. But your basis is correct, because if you have, if you're giving up multiple managers with you know, smaller asset bases, typically you're not going to hit, say, sort of break points.
What is a theoretical efficiency with using one manager? And you would lose that by changing your to multiple managers, if you will. But
Yeah.
I understand. But the fact is, your inclination would be likely more expensive in terms of the fees, but obviously you can't say because you don't know who those managers are or what they're
Correct.
charging you.
Correct.
Right.
I don't think it would, you know, from what I know just of other plans, I wouldn't expect it to be radically higher or radically lower, actually. I think it'd be pretty consistent with what we see now with the one manager, but you can't say.
How much do we pay, what are our fees associated, what do we pay manager?
There,
It's in your policy statement.
In policy?
there is a, oh, that'd be a 93. So the fee schedule is, the first 3 million are assessed a fee of 0.70%. And then the remainder of the assets are billed at 0.65%.
That's pretty standard.
That gets to, effectively, about 0.66. So I think, they'll say plans, you want to keep costs below 1%. I think most plans should do better than 1%. So I would like to, 3.25 is where I would like to say you're being pretty competitive. So at 0.66, that's from a fee standpoint, that's fine.
And that's every year off the top, everything that we have in the plan, right?
Well, it's, again, without their agreement, I assume it's quarterly, it's based on a changing market value. So that fee schedule is assessed based on a market value, which theoretically, they will make more money if the, if the plan value goes up, but at the same time, the invoice is lower if the market value goes down. So it changes a little bit.
But this is off of the total amount of money that's in the fund, correct? Yes, so it's not a percentage of what they make us, it's the whole fund.
Correct.
Okay. Have we asked for or been given any type of reimbursement for, management fees for performance over the last few years?
That is, if council would, I believe, and this is something that I think would be good to address at the meeting with Manning and Napier, I believe their standard fee schedule, their stated fee schedule is 0.75%, so there's a slightly more advantageous fee schedule to their stated fee schedule. We have engaged with them in the past regarding, looking at potential fee reductions when it's at the direction of a client. So, if we have that direction, we can talk with Manning and Napier. We've had clients that have looked towards moving towards a performance-based fee schedule, whereas they could potentially make a little bit more if they outperform, but they will make a lower amount if they underperform. So we can engage and show you different potential scenarios, but again, that's something that would be between the manager and council, but we're happy to work on that for you.
Why did we only go back 5 years on this? Because when we first saw our report, they were back 10 years. When Kim and Greg and I first came in and we got our first report, they were going back to 10 years. But this is only basically going back 5, in general, other than that one section where it said 10. Because if we were looking at the last 10 years, it would be even worse.
I can point your attention to 10-year.
Yeah, I know, I saw the 10-year, but if we looked at the overall, you've only got the general listing for 11, 12, 13, 14.
Oh, on that particular page, the calendar years. Yeah, so.
Because they did really bad in 2009 and 10, if I remember correctly.
They did actually quite well, it looks like, in 2009 and 2010.
2009 was right after the stock market crashed, and
right. So they struggled more in 2008.
Your first that was 2008 was in the middle of the year when it happened. Was it 2008 that was so awful?
Yes.
Yeah.
Okay, well, still, if this had gone through the last 10 years, that would have only been 8 years ago.
Okay, so page 9 shows calendar years. We can add a
No, I
second.
saw that.
Okay, so that goes back to 2008. We can add a second, there can only fit so much on the page, but, we can add a second page if you want to see every single calendar year back to, we would be able to, we could add that.
And that's the minus 22.78. So it would really, if we had gone back to that on page 11 or whatever it was, or 10, it would have looked even worse.
Since inception is in there. That goes to the very beginning.
Yeah, so 2000, when we talk about the inception return, that includes the experience of 2008. It includes the entire experience, good and bad years.
Right, 9 probably came towards the end.
And do those include the numbers
So-
excuse me, on this page right here?
Page
What-
9.
No, doesn't the preliminary show from inception, 8.16? Am I looking at the wrong number?
Yes, so that includes every
Yeah.
good and bad and terrible and great, month and quarter.
With an
over
inception
that.
date of April 1st of '03.
03, correct.
Right.
So since 03, you've had 3 good years? 4 good years? 2009, 2010, 2012, and 2013?
I don't know what the definition of good year necessarily is. I mean,
Well, over 10. Over even 8.
But we're comparing this with a peer index, right? Right.
we have a comparison to a peer index and to just that sort of benchmark we've talked about, that policy index. So we do compare it to peer. So
Your
peers
peer
and-
index is S&P 500 and the 3,000.
The peer index, we're
plus the
comparing your
3,000.
experience relative to other similar pension plans. And then a benchmark would be, say, an S&P 500, so that's a benchmark. That's a benchmark specifically for domestic equities. So we wouldn't compare the total fund relative to the stock market. That's not sort of the relative comparison.
So is it fair to say you're basically recommending we do not diversify because you're due for a break?
I don't,
Well, the last couple of years have been bad, but you've started out good, especially last year, the first 3 quarters. And you're saying they've never done bad twice in a row, so you think they're gonna
yeah, I think.
probably do better next time?
I think our return experience, I mean, and I know you haven't, been on, seen a lot of the updates in the past years and the reports, but, the return experience, if we went back to '03, generally, not always, but generally has been good. Again, we've had most periods in which they've underperformed, and again, every strategy, every manager underperforms in certain environments. So it's been atypical to see them, the stretch that we've been highlighting and talking about, that's an unusual stretch, and that's one reason why we're concerned, because they've always bounced back in the past. I think we've seen, 3 of the last 4 quarters, they've, outperformed. In the first quarter, this year was extremely strong, so I think it might be worth seeing, I think if this is the rebound that we expected, if the performance cycle is changing, I think this would not be the best time to make the change. So again, the recommendation at this time would be to continue.
So, okay, so we're expecting a rebound is what that's why we're
You say
saying.
we're to closely monitor to see if there is one.
Right.
That's why we're checking.
Well, and based upon the first quarter, that was a pretty good quarter,
Right.
right? Now,
April,
this
May.
is,
Yep.
am I correct that when you look at this piece of paper that I'm holding here, that when I referred to before, performance update as of May 31st,
He's talking about the
2017.
second page of the
So I'm talking,
2-page.
well, I'm not, yes.
Second page of the
One holding
2-page
it.
pamphlet.
Isn't,
The performance update.
is the inception number 8.16 from April 1st of 2003. First of all, that is an expression, that's expressed in terms of a percentage return, right?
Correct.
Okay, so we've had a percentage return over those years from '03 to, through today, basically, whatever, precisely what the cutoff is, of 8.16.
Yes, on an annualized basis, so
Now,
per year.
Isn't that pretty, that's a
Is
pretty
that
good return?
That is
before or
good.
after after your cut?
Or, that does not include, our fees. I think our fees, you know,
It's a flat rate.
Or a flat-
This fee's a flat rate.
and I think it,
Manning and Pierce is the one he talked about, it's on the percentage.
6%.
But you're saying this
His fee's
percentage would be
$60,000
lower
a year flat rate.
if
Well,
you take into
yeah, that's what I'm
account
talking about
fees? Is that what you're saying?
yes, but peer group comparisons are done,
Right, well,
gross.
but in general, that 8.16, that is, you regard that as a good return over that period of, how many years? 15 years?
Yeah, I mean, roughly, yes, that over that time
Right,
period is,
so a person ought to be happy if they're getting that kind of return for that period of time, right?
yes, which,
Okay.
again, it reflects the long-term strength,
Well, that's right,
but,
But not if everybody else is getting 14%.
well,
Yes.
I don't,
That's what we're talking, that's why we're
Well,
comparing with.
is
peers.
it?
right,
Is
exactly.
everybody, well, that's right, or 25%, but aren't
Right.
people getting 14%?
That was just a made-up number.
Yeah, well, that's what
Yeah.
I'm, well,
But I'm
but
just
here's the
saying,
numbers we're
that's
looking
the-
at here.
That's what
But
matters.
we're comparing this against the total
So-
fund equity, the index rather.
So the best comparison for, you know, for that, for what other, you know, what's everyone else doing,
Isn't that the total fund policy index?
is to go, if we look at April, that update through April, sorry, because, again, May, it's still pretty early.
All right, sure.
And again, when you look at that inception return, and then that ranking that number in the parentheses, so that's gonna
Right.
be the peer group ranking. So compared to other public pension plans, you return in the 23rd percentile. So that would be, you have a return that is better than roughly, you know,
75%.
75% of
Right.
other pension plans over that time
All
period.
right.
In the median plan over that time period, the 50th percentile would be 7.58%.
I got you.
So yes, relative to the peers and then to the benchmark, which would be the policy index, the plan has outperformed since that 2003 date on an annualized basis.
Depending what you want the number to be, you know, whether people are happy or not with their investment advisor is a function of, to a large degree, on their subjective view of what they want. Somebody can be unhappy with a 14% return and say, gee, I ought to be getting more than that. But this is not a bad return. That's the only point I'm trying to confirm in my own mind. On the April 30th one, an 8.12%
Correct.
return.
That is
But
correct.
that's not bad.
No, it's not.
I mean, we shouldn't be wringing our hands saying, gee, we really screwed ourselves somehow, but because that is a good return, right?
Exactly.
Okay.
It is, yes.
Right,
That's about what we expected.
okay. That's fine, but we've made the decision here, I think, to defer taking any action, other than not taking action, till the following, till August.
Correct.
Okay,
And again, a lot of that is based on the fact that they have added value and the planned return has been, you know, that is a good return over that time frame.
and as well as in the first quarter.
Yes. But we don't, you know, but
No,
certainly
I
we're,
say you don't measure quarter to quarter,
Yeah.
but we had 3 good quarters, 1 bad quarter, and then they got back on track
Right.
in the first quarter of 17.
right, so we're hoping 17
Okay, yeah.
continues
But we
and,
had 5 years of bad quarters before that, that's
Well,
what the
I don't know,
issue
Kim,
is.
No.
5,
Well,
is that
that's-
true? 5,
that's-
She said 5 years of bad quarters.
I don't think that's true.
That's not true.
Yeah. Isn't that what they said, 5 years of underperformance?
that,
By how much?
well, I'm looking, again, I'm just looking at what's in front of me. But we can look at, I mean,
I was just quoting your paper.
yeah, so over the last, so as of the stretch, as of March 31st, 2017, if you looked at their return versus sort of the policy index return, they were underperforming by 0.14%. So they had not, over the last, you know, the last 5-year return observation, again, this is an observation that changes constantly because as of April, they're outperforming over the last 5 years. But as of that time period, the return was slightly below that policy index.
You understand, Kim, that's fluid. So.
Right, I do understand.
Where are you pulling that number on, that we're looking at?
What did you get the .14?
Yeah, that last one that you.
That was just math from, if you were to look at, we'll go back to, page 11.
Okay,
So there is the 5-year return, is 6.87%. The index return 7.01%. So the difference is 0.14%.
But your .14% is on page 10, third line down.
Right, and that's just a written expression of just the return difference over the last 5 years that you can see the numbers are on page 11, you see the 5-year return.
Right. 7.01 versus 6.87.
Okay, do we have any other questions from council?
Did we all agree on that? Because I heard your opinion, I didn't hear anybody else say what they thought. Bill, I guess,
Yeah.
you.
well, I accepted his recommendation and to defer till
I'm
August.
satisfied with waiting until August till we see what happens.
I would personally be thinking diversify now, but I do think the rest of the year is gonna be fine. I think in the middle of next year is when we're gonna start having problems.
I'm fine with waiting another quarter.
Do we have a consensus then? What do you think?
No, it's like I said before, it's like trying to chase a hot stock.
Well, you
You're
gotta
never-
make a decision. I mean.
Well, I mean, waiting is the.
Okay,
is
you're
the-
waiting, you're okay to wait?
Certainly,
How
you know,
about you, Greg?
Yeah, I agree.
you don't jump from manager to manager just because you're chasing a
Well,
hot.
we haven't done it for the last time of year.
No, but I mean, that would be my recommendation, if you
Okay.
don't.
Jerry?
I agree.
Wait till August?
Right.
Okay, Bill?
I already said it.
Okay,
Yes.
okay. No other questions from council? Thank you, Justin. Appreciate your report and your time. Okay, and we'll move on to seminars and conferences. Just to remind you that ALOM is having a legislative outing on July 24th. If you are interested in attending that, you need to get in touch with Marie so that she might make reservations. And at this point, any comments from the audience? Pardon me?
About what we just did.
Yeah.
Just a question.
Hi. Am I to understand that you do this observation of our finances for every municipality? Or you have to do that, or every municipality has someone look over and make recommendations like this? Is that how it works? Can somebody answer that?
Well, how about if I answer, does every municipality? I don't know what every municipality does, but the more managers I talk to, it seems like some are willing to take the advice that Bill Reese gave us back years ago, and I think Carmen does, because Bill's a fiduciary expert, that it's wise to have someone who is an investment consultant that's able to look at various tables and various ways of.
So he's sort of the buffer between you and the investment manager to help
Buffer is
you
a
make
great
those
word.
decisions.
Sometimes
Okay.
people use the term
Independent.
He's not paid by any
He's
manager,
in-
and he just gives us
Okay.
advice and measures. performance.
sometimes it's almost referred to as an insurance policy.
Right. I had done a little research because I was interested in how other municipalities do it, and a lot of them have pension boards, which are separate from the township commissioners or people that are elected.
You have pension advisory committees.
You
It's
do?
made up by police contracts, the representative of the police department, the finance chair, and me.
Okay, so you do have sort of a pension board. Okay, wonderful, thank you.
Any other comments? That concludes my committee, Mr. Chairman.
Okay, zoning committee?
There's no items to be discussed for the zoning committee at this meeting.
And as far as we know, the meeting's adjourned.